Continuing on with our discussion on some of the largest protests in China seen in years as people fight COVID lockdowns. Markets are reacting negatively, fearing the impact on China's manufacturing as the holiday season begins in earnest. Joining us now for more, we've got John Augustine, who is the Huntington Private Bank CIO. Thanks for joining us here on set today, John.
Thanks for having us.
Absolutely. All right, to start things off with what we're seeing right now in China and how that kind of has a more outsized impact from your perspective. What do you believe are some of the biggest areas that could be reactive or continue to be volatile as a result of what we're seeing in China?
Well, markets are reacting the way you'd think so far this morning. Stocks down, commodities down, bonds up, except one thing, the dollar's down. So it'll be really interesting to watch this afternoon to see if it impacts European markets this morning, but then we have some rebound action in the U.S. this afternoon. So China does more trade with Europe than the U.S. So we're seeing Europe stocks down a little bit more today. Obviously commodities, that impact obviously Apple. But it's really Europe that's the epicenter with China more than the U.S. right now.
If the situation in China, John, continues to escalate, is that enough to push the U.S. into a recession?
Probably not. We're a pretty closed economy. About 15% of our economy is exports. So we're fortunate, we're pretty closed in that environment. Probably the Fed's going to have more to do with the recession than China will. But it's going to slow down some big companies. Yeah, it's going to slow some things down. And Apple's the one today, and every day we'll probably discover one.
Okay, so let's get to the Fed then. If the Fed, I mean, and that's pretty, I think there's broad agreement that the Fed is the big risk factor, right? Or a big risk factor for U.S. recession. So how are you gaming that out at that point? At this point, what do you think is going to happen?
So our call from our economic team, Fed goes 50 on December 14th. That'll put them at 4.5. The expectation for inflation next year is 4.3. So that may give them, if they want, a reason to pause. Now their next meeting won't be till February 1st. You know, it's thought 50, 50, 25, then the following one's in March. But if they get above the expected inflation rate next year, if they want, that should give them a reason to pause. We'll see. More to come, obviously.
Interesting. Okay. And so with that, where do you believe that the economy will stand at that point?
We're thinking the economy may be a little bit better than expected.
Interesting.
So it's really uniform right now that earnings are going to be down, S&P 500, GDP is going to be down first half of next year. To us and our equity team and economic team, it's a little bit too uniform. And right now we're going in this fourth quarter, we're 2/3 of the way through the fourth quarter, where the Atlanta Nowcast model says the economy is doing much better than economists think it's doing and the Fed thinks it's doing. So that'll be interesting as well. So we may be going into next year with more upside economic momentum than downside, even though our economy always slows in the first quarter of the year because it's cold out. But we may be going in with more upside.
Well, you know, we're coming up against the year end here, John. Are you seeing any customers or any clients take some interest in tech stocks? It's been a horrible year, notably in big cap tech, but these stocks can't go down forever just given their cash positions.
Not big cap tech yet, but some small cap. So for instance, our equity team, the other week, they bought some Electronic Arts, but then they bought some Emerson Electric. So they're kind of coming in baby steps, smaller tech, probably large tech. You want to keep some. Obviously, it's so big in the indexes now. But our equity team's underweight. But the moment the Fed utters, yeah, we're about done, they're going to scream up.
And John, it's interesting that Saz asked about clients because you guys are private banks, so relatively high net worth individuals. Are you seeing any change in their sentiment as we get towards the end of the year, especially with what stocks have done this year? Are they changing what they want to invest in, what they want to spend on? What are you hearing from them?
Cash. So cash yields 3.5 now. I hadn't done that since 2007. So for the first time in 15 years, cash and bonds are interesting. Now we caution them, okay, that's fine, 3.5 is fine. But if these accounts, you want them to grow over the inflation rate for the next generation, that's not going to get you there. There's a lot of happy retirees in Florida right now who are finally getting some interest on their savings they haven't had for 15 years. So cash is where we're seeing the most questions right now because it's not zero.
But is it because of the yield or is it because they want safety or
Yield.
both? The yield. Interesting.
The yield.
Huh.